Good afternoon, everybody. I hope you guys can hear me clearly. My name is Sean van den Berg. Welcome to our webinar. The topic today is Introduction to the Share Market. As we do with every webinar, any questions you guys have, just type it up in the question box and I can see it and I can handle it as we go along. Just remember also this presentation is being recorded, so I'll be sending you the presentation as well as the recording for you to review, and obviously that's where you'll also get a lot of questions. You're welcome to email me any questions from there. But let's get started. Here's the agenda for today. It's basically two parts. I'm going to discuss some basic share market concepts. What is a stock exchange? What are shares? I discuss various different classes of shares. But also the pros and cons, or advantages and benefits of getting involved in the market. Many of us don't know that you have rights as a shareholder, so we discuss that. And quite a few people have asked us to discuss the dealing costs and how that thing works, and etc. Just a quick little tip, things you should know before getting started, and things like that. But I want to focus also a lot on how to choose your first shares. I think a lot of people feel overwhelmed, so I'm just going to discuss a very simple 4-step process, and obviously that will give you a very basic idea how to choose your first shares as such. Anyway, let's get started. So any questions you guys have, just type in the question text box and we take it from there. Okay. So first of all, this presentation is based on the tutorial number 1. So you'll find it on our resource section. If you click on our resources before logging in, and then go to the tutorials, and then you'll find tutorial 1. So this presentation is loosely based on that tutorial. So it also gives you some more information and some background as such. Okay. So let's get into the nitty-gritties, as I say, basic share market concepts, and we'll lay down a foundation, from there we move onwards. Okay, so first of all, what is a stock exchange? It's a forum or marketplace where shares in listed companies are bought and sold. It's as simple as that. So a company would be listed on the stock exchange and would issue shares in its company. So you as an investor would acquire a portion of that company, look at it as part ownership, when you purchase those shares. So the proceeds are used, this is where once a company lists on the market, they use the proceeds from that listing to finance future projects or to reduce debt. We'll discuss it a bit later. You as an investor obviously would buy into the share because you anticipate growth, but also you have the opportunity to divest of your ownership by selling to other investors. Okay. So the idea is that obviously you as an investor want to realize some profits. If you sell the share at a higher price than what you bought it at, and that's how we start making money in the stock market. Okay. So you must understand there are two markets that run side by side. We have the primary market. This is where the companies come to the market and they sell their shares in the company to the public to raise funds. And as I mentioned just now, obviously to expand their businesses or to reduce debt and things like that. But also, very importantly, there's a secondary market. This is you and I as the public will buy and sell those shares between ourselves. Okay. So it's very important that you understand that we have to have the two markets. A company won't come to the market knowing that there won't be willing buyers, but also as an investor won't buy the shares if they know they won't be able to sell the shares again. So it's very important to have a very healthy secondary market as such. Okay. Just also understand, once a company comes to the market and lists its shares, it derives no further direct benefit from its shares trading in the secondary market. Obviously, they want to see growth in their shares. Down the line, they might issue more shares at a higher price, what they call a rights issue. That's if they expand their business further and things like that. So obviously, it's in the management interest to make sure the share price grows and things like that. Okay, in the sense that they'll benefit from a rights issue down the line where they don't have to issue some of these shares because the price will be much higher. Okay, so let's just give you a quick background regarding stock exchanges. Because understand there are obviously stock exchanges right around the world. Here in South Africa, obviously we have what they call the JSE. Just bring up my little spotlight. In the top right hand corner, yeah, you'll see this is what the JSE looks like. This is the entrance from Maud Street. The JSE is situated at the corner of Gwen and Maud Street in Sandton. That's the JSE logo. That's what it looks like. Obviously, we've got exchanges right around Africa. We've got the Nigerian Stock Exchange, the Zimbabwe Stock Exchange. Obviously, the biggest in the world would be the New York Stock Exchange. It's quite interesting that they run two kinds of markets. They still at the floor, but they also use that computerized system also. So it's interesting to see they run the both systems together, and that's the biggest market in the world. This is the Nikkei, the Japanese Stock Exchange, all based in Tokyo. And then this is just a screenshot of Euronext, which is based in Amsterdam. And basically it's the markets of Belgium and France and all the other, most of the European markets are joined together. Obviously this electronic platform. But the point is that the stock exchanges all over the world, and obviously JSE's got very close ties to the London Stock Exchange, and things like that. Okay. So what is the role of the JSE, the Johannesburg Stock Exchange? The JSE itself offers a regulated trading platform, so where you and I as buyers and sellers can trade the shares. And obviously the main benefit there is that you have protection as an investor through its rules and regulations. Okay. The JSE guarantees all trades transacted on the JSE, so there is that recourse. There's things like guaranteed funds and things like that. If a broking member or a staff member of a broking firm goes astray with your money, there is recourse for you as an investor. So you've got a guarantee. Also, the JSE offers itself a wide choice of companies listed on the market and various financial products that you as an investor can invest in. But the main idea with the JSE, the main objective is to provide an active and liquid market. So you and I can buy and sell those shares in the secondary market. Okay, until 1996, we had the old JSE floor. This in the top right-hand corner. This is what the JSE used to look like. This is still down in town, in JSE in town, Diagonal Street. So the trading floor as such closed on the 7th of June 1996, and that system was replaced by what they call the automated system. It's now called the Johannesburg Equities Trading System. And obviously that was, at that point in time, it was designed by the Chicago Stock Exchange. But that JET system, that Johannesburg Equities Trading System, was replaced in 2002 by the London Stock Exchange's automatic trading system called SETS. That's why I say the JSE has a very close relationship to the London Stock Exchange. But basically, we've moved from a system where we actually used to have the share certificates, moved everything over now to electronic. So we went through the process of dematerializing those share certificates and moving over to a electronic environment. So everything is moved over to what they call straight, stands for share transaction totally electronic. So everything is settled electronically. Okay. But also it provides a system where you have a rolling contractual and a guaranteed settlement of all equities, and that basically takes place in what they call T+5, trade plus five business days. That's how when settlement will take place. But basically, it's an audit-driven, centralized, automatic trading system. That's how we trade at the moment. It's an order book where the buy orders from investors are matched with orders from sellers. Like good old days with the JSE on the floor, we have buyers and sellers matching up in front of the boards. Now everything is done electronically, so it's all on screen trading. Obviously, it's operated still by the traders, by the dealers and things like that. They're still entering the orders, the buy and sell orders, but everything's done through remote terminals. So you don't actually have to be at the JSE building. Okay, PSG Online, for example, we're based in Bryanston. Okay, so everything's done electronically. That's a big difference now. So what's the advantages of that? There are a lot of improvements for you as an investor, obviously listed companies and the trade itself. Bottom line, increased or enhanced investor protection. So you've improved transparency. The JSE can cope more with increased capacity. And obviously, as I say, from an investor protection point of view, there's real-time surveillance, there's better security, and obviously there's a better audit trail. Okay. One of the other things that happened after 1996 is that brokers can act as a principal, as opposed to agent or middleman. But most broking houses or broking firms have chosen not to act as principals. Okay, if the company does act as a principal, they actually sell shares that they own to you. They have to disclose that and things like that. Okay, so there were some changes, but just understand most brokers are still trading as an agent, middleman between the buyer and the seller. So let me see if there's any questions coming through here. In the meantime, okay, here's some questions. Hang on, let me see here quickly. By points, by example, this is 46,000. This is a question from Justin. Okay, Justin, I presume you're referring to the indices, the index, which is just a barometer of all the shares on the market. For example, the Dow Jones trading around about 15,000 points. It's just a barometer compared to, for example, 10, 15 years ago, that index might have been at 1,000 points, and the market has grown 15 times since then. Our JSE at the moment, yesterday we made a new high. We're getting close to what's 43,000 points. So it's just a barometer of where the market's going. So it's just a measurement tool. So remember, it's an index. So it's just that's why it's in points and things like that. And obviously, different markets are based on different ways of weighing which constituents are important in that index as such. Okay, guys, I hope you can hear me because there's a question here coming from Renal. Sorry, Renal. Yes, that was a question just now from Justin. He asked a question about the index. Different markets have different indices and different values, and I just explained that. Obviously, it's just a barometer of where the market was and where it is now. So it's just a barometer, a measurement tool. Okay, but keep those questions coming through. I appreciate that. So bear with me. Sorry, the guys are good. Okay. Anyway, guys. So as I say, just keep those questions coming through, and I'll try and answer as we go along. Okay. Oops. Sorry. Let's go back to my cursor here. Normal cursor. Okay. So, what are shares? Remember, as I mentioned just now, as companies expand, they might require additional capital to expand those expansion products. So, they'll raise the capital. That's the magic word there. Raise capital by selling shares in the company to investors. So, each share represents a part ownership of that company. So, you, as a shareholder, entitled to vote at the AGMs and things like that. But also, obviously, eligible to receive dividends if and when dividends are paid. So you as an investor, when you purchase those shares, you are now termed as a shareholder. You hold a share in that business. So you only receive dividends if the board of directors declare a dividend. And remember, dividends are only paid out of profits, not out of capital. So it gets paid out of profits. If and when there obviously are profits. Another name for shares, by the way, is equities. I like to use the word equities because it always reminds me that we're sharing equally in the profits and equally in the losses. But also shares are referred to as stocks. Americans like to use the word stocks. And the nice generic term is securities. But securities usually encompasses all the financial instruments, be it derivatives, you name it. So there is a direct relationship between the number of shares you own and obviously your portion of ownership in that company. The more shares you own, obviously, the greater amount of the company you own. So, for example, PSG owns 35% of Capitec. So we are a major shareholder of Capitec shares. So you as a shareholder also, you might have 1% of Pick and Pay. You're not as big as the Ackerman family, but you do have a sizable portion. Okay, so that's how we would work with shares. There are different kinds of shares. So the most common one, the majority of shares listed in JSE are what they call ordinary shares. So ordinary shareholders have the voting power. That's a major big difference. You have the voting power. You're allowed to go to the AGMs and vote on important matters that affect the company. And you as an ordinary shareholder obviously have ultimate control of the company. So you have no rights to the profit until dividends have been declared. only as and when there are profits, obviously there are dividends declared, then you'll get your equal share of those dividends. Okay. If the company had to go into liquidation, the company had to wind up, any residual claim against the assets, obviously after all the assets have been sold and the liability has been settled, anything that's settled after that, you'll have a portion of that. Okay. So just understand that ordinary shares have no specific maturity date or fixed income compared to, we'll discuss now, debentures and preference shares. So there's some differences there. So ordinary shares, being the major listed shares in the market, obviously are affected by price volatility. And you as an ordinary shareholder will assume greater risks compared to a preference or debenture shareholder. Okay. So most companies which usually issue an ordinary share and then obviously in subsequent expansion plans might issue some debentures or preference shares as they expand. But just understand that most of the shares that we trade with on the market are what they call ordinary shares. You'll be called an ordinary shareholder. So they will also have what they call preference shares. The big difference between a preference shareholder and an ordinary shareholder is that you have preference or first option when it comes to the dividends. Remember, again, only as when they're declared and paid out. Okay. So preference shares, they are guaranteed of a specific percentage of dividends where the company makes a profit. And you as a preference shareholder have a prior claim to any repayment of capital if the company has to go into liquidation. So you'll get paid first before ordinary shareholder. But saying that is that you do not have any voting power. So that's another major disadvantage with a preference shareholder. To understand, there's also various classes of preference shares. You get what they call cumulative or convertible or redeemable or participating preference shares, as well as fixed or variable rates of preference shares. I'm not going to go into too much detail here. Just understand that the dividend rate is usually a fixed amount, and let's say that happens that the dividend is more regular and more stable. So we would go for preference shares. Someone is looking for a hybrid between debt and equity investments. In other words, someone is looking for medium risk or a return. Obviously, risk higher than debt instruments, okay, but lower than ordinary shares. It's a nice way to, if you're looking at more income in your portfolio, you're a bit more of a mature investor, you're looking at more stable, but looking at more income, then maybe look at the preference shares. And all the major companies will have preference shares available for them. So you're still getting at capital growth, but also now you're looking at some income. Okay. Debentures, this is what I call the loan contracts issued by the companies. Think of them as interest-bearing securities. They represent the promise to pay interest on a regular interval, but also obviously to repay the capital. So basically the company is borrowing money from you to expand their business. Instead of going to the banks, they're coming to you as a shareholder. So it's very similar to a fixed bank deposit. They pay interest on your on that loan to you. However, you're not receiving any dividends. Okay. So remember, if it's interest, obviously there's tax involved. So you must also understand that. Again, they're classified along with various things. We talk about security. They're classified on the term, the duration, and also obviously the yield. And also there's various classes of debentures. So I'm not going to focus too much on this. Remember that online tutorial will also cover a lot of that. Okay. So what are dividends? So if I had to compare it again to a bank, where a bank deposit will attract interest or pay interest, shares pay dividends. Okay, dividends are paid out of company's profits to the shareholder, usually distributed as either a cash dividend, okay, or a scrip dividend. This is where a company wants to preserve or conserve the cash. They'll pay out shares instead in lieu of cash. So they usually would do a check or bank transfer. Easier when you got a trading account, it automatically put into your account. Okay. So scrip dividends, as I say, are paid in the form of additional or new shares instead of cash. And as I say, they want to conserve cash flow. So remember, the dividends are not fixed compared to preference shares, and obviously they're at the discretion of the directors of the company. Okay, remember the directors of the management, and they decide, okay, how much are we going to pay out in the form of dividends? It's usually about a third, whereas the other 2/3 of profits gets reinvested what they call retained income for future expansion. Okay. Obviously, dividends are declared most of the time every 6 months. The first part of the year is what they call the interim. The first mid-year through the year is such what we call the interim, based on anticipated profits for the full year. And then obviously you have also the financial, for the full year you have what they call the final dividend. Okay. So it's a nice way of looking at income coming to you every 2 months. Obviously, it's one of the criteria I always look at. I'm looking at dividends, and that's a form of passive income. You as an investor looking at growing your portfolio, build up passive income, and dividends are one way to go. So what are the benefits and advantages of getting involved in shares? A lot of people have the impression that you need large sums of money to invest in the share market. No, you don't. You just need a reasonable amount. We're talking about it just now. Obviously, the more you've got, the easier it is when it comes to diversification and building a portfolio. But you don't need lots of money to get involved. Now, obviously, there's various ways of getting involved in the market too. Either be it through exchange-traded funds or through unit trusts. You can still get exposure to the market. What we're talking about today, obviously, is direct investment through shares. It's also very easy to get in and out the market, depending obviously the shares you're trading at. So it's very easy to get in and out, to liquidate your shares. Think about being a shareholder, obviously not involved in the day-to-day running of the business. Okay, so you're not physically involved in the business, but you're a shareholder in the profits. And I mentioned just now also obviously the losses, if the company makes any losses. So any losses as such, you're not responsible for those losses, but obviously your share price will drop in value. So there is limited liability. So, you know, the question always is, what is the risk? The risk is the amount of money you're investing in the shares. So if I want to go invest 5,000 Rand in a company, that's my risk. I've got potential of losing that 5,000 Rand. Okay. So you can eliminate that risk by obviously teaching yourself more about the market and just following a sound investment approach. And we discussed a process just now. But guys, the idea is to follow quality stocks, and then obviously the idea is to value stocks on a regular basis and things like that. You have various rights as a shareholder. Remember, you have the right to receive dividends, you have the right to vote, you have the right to equal treatment at all times. You have the right entitled to competence, integrity, and honesty. This is from company directors. Obviously, that's why we have the whole King corporate finance or corporate governance story because of that. But also you have a right to be kept informed, and that's where the Johannesburg Stock Exchange news service, sales announcements, and financial press comes in handy. Okay, so how does trading take place? Let's talk about dealing costs. First of all, obviously brokerage. This is what you pay as a fee or commission to the stockbroker on your behalf. At PSG Online, we use a minimum of 98 Rand per trade, but there's also a sliding scale. So remember, the brokerage scale excludes dividends, excludes that. But anyway, you can see on the screen here the sliding scale. But also, there are also other mandatory costs and charges. There's VAT, 40% VAT on brokerage, and settlement costs, and a protection levy. We talk about a securities transfer tax. This is a levy that's charged on the purchasing arm of the transaction, 0.25% of the value of the transaction. Remember, you don't get charged as levy on the selling part. That's when we spoke just now about the share transactions totally electronic. No settlement cost. There is a cost involved there. And that's again on the value of the transaction. There's a minimum of 10 Rand 92 with a maximum of 54 Rand 59. So obviously this cost you also have to take in consideration. We spoke about just now about the surveillance department. So obviously we pay for that in the form of the investor protection levy. You see it's 0.002% of the value of your transaction. So a few cents here and there. But those are the costs that you have to take into consideration every time you buy a share. Questions always important to ask is what kind of strategy you want to take on, and I always suggest people decide for yourself: am I an investor or trader, or am I both? So obviously, as an investor, your strategy is more passive management. Your view is 3 years plus. So your strategy is more of a buy and hold. You go look for quality undervalued shares, and your goal is to build up a balanced portfolio. When I say balanced portfolio, some financial shares, some industrial shares, some industrials. some resources. So your goal is still capital growth, but also you might then consider obviously income, and that's in the form of dividends, and growth in those dividends. If I'm an investor, if I buy once and I don't sell, obviously I'll have low brokerage costs. So that's very important to consider that. If I buy and hold for at least 3 years, and after 3 years decide to sell the share, then capital gains tax applies. And you'll see in the next slide, we have a little example where I explain how capital gains tax would work. As a trader, obviously, it takes more time, so we talk about active management. I've just done the opposite here. Your view is less than 3 years, and obviously it depends on your strategy. I talk about position trading. This is more what they call an active investor. You're holding the position from a month to a few weeks to a few years. Okay. Swing trading is obviously a bit more shorter term. We're talking about holding a position, holding some shares between two days and maybe 30 days. Whereas jobbing, this is a speculator in and out the market on a daily basis. Obviously, the size depends on the size of the transaction, but usually the jobbers or the speculators will be using more the derivatives, like single stock futures and CFDs, because they're more capital efficient. But as an equity trader, your goal is still capital growth. You want to take advantage of the cycles, buy when it's low, and sell at the top of the cycle. When it comes to derivatives, for example, you do the opposite. You sell high at 10 Rand, buy back at 5 Rand. So remember this, that sell high and buy low, that you cannot do that with shares. That's what we call bear selling, and that's illegal in South Africa. That's why you need to learn more about derivatives trading to take advantage of falling markets. But just remember, as a trader, if I'm buying and selling the whole time, your costs will be higher, so you'll have higher brokerage costs. You need to take into consideration when you break even, and obviously all your take profits and things like that. If I'm a trader, those profits will be considered as income. So obviously you have to add that onto your income tax, and obviously it depends on what tax level you are. You can pay up to 40% tax on those profits. But let's go quickly as an example. Here we got a situation where someone's made 100,000 Rand capital gain. The first 30,000 Rand of profits is exempt from tax or from capital gains tax. So in this situation, let's say 30,000, you have a 70,000 Rand taxable gain. Then they have this thing called an inclusion rate, which just bumped up down the last budget speech to 33 1/3. So that's inclusion rate, and depending on what tax rate you're on, so 33% of your tax rate, in this situation we're using an example of 40%, so that equals 13.32%. So that as a percentage of my 70,000, in this situation will equate to 9,324 Rand that you need to pay tax on your 70,000 Rand gain. Okay. There's a question coming through. This is from Johan. He's asking me about the risks. Yeah, obviously there's always risks involved, and the formula there is the higher the risk, the higher the potential return. So there's two kinds of risks. You've got the risk that what we call systemic risk, is that the whole stock market can fall. And how do you manage that? Is that you use things like stop loss, you use things derivatives like single stock futures to hedge your position. So there's ways and means to manage the risk. That's what we call systemic risk. That's that the whole market will fall. And Jan, another question is that obviously the other side of the equation is what they call unsystemic risk. This is a share that the risk that the share that you buy into will fall. That's more specific in the sense that I'll use the example of Rainbow Chickens. I remember a few years ago, Rainbow Chickens, obviously involved in chickens. Their whole stock, all the chickens were affected by a thing called Newcastle disease. They had to kill all the chickens, and obviously that affected their manufacturing or their productivity, and obviously affected the profits. So how do you minimize unsystemic risk? You want to diversify your portfolio. You don't want to have all your eggs in one basket. You want to have between 8 and 12 different companies, and maybe spread between 3 and 5 different sectors. So that's how you would manage risk. But as a starting point, always I suggest to people, your first investment always is educating yourself. If you can educate yourself about the market, you feel more confident, you make better decisions. And that's when you're halfway there. Okay. Now let's move on quickly. Things that you should know. This is what things I've learned over the years. Never buy shares in tips. I always say there's always a tip, there's a tap. Why they're trying to dump the stocks on me. Always do your research in the share and ask yourself the question, would you have bought the share without the tip? Obviously, that's after looking at research and things like that. I always suggest also write down the reasons for buying a share. So with hindsight, you can learn from the experience. Okay, so that's how you start learning more about the market. That's why I say always justify your purchases by backing up with reasons. Write down your reasons. Never be greedy, and this is the biggest challenge in the market. Obviously, emotions are very, very important, and it's important that you control your emotions. On the one side, you're greed, the other side is fear. So don't get excited when you make money, and obviously don't get disappointed when you lose money. Your goal is to teach yourself to be objective. So be aware of the emotions, but teach yourself to be objective. Okay, so never marry your winners, and never snub your losers. So never, we're talking about never borrow money, never buy shares or borrow money. Don't take money out of your bond and go buy some shares. Obviously, the market goes against you. You need to pay back the capital plus interest. So that's what we talk about here. This is obviously with equities. So let's get on to the more of the important stuff, how to choose your first shares. Let's see if there are any more questions coming through here. This is a question from Terence. Can one buy preference shares on the JSE? Yes. Obviously, most of the time you find that the shares will have the normal share code, SOL, and usually have a P behind it for preference, and that's why you distinguish it. But there are all those preference shares available on the JSE. So Terence, hopefully that answers your question. Here's a very important question here from Stephen. If I want to buy 100 shares, will my broker fees be more if I buy 50 shares than 50 shares later? Okay, good question there, Stephen. So first of all, when it comes to trading on the market, first of all, there's no minimum amount with PSG, so that we don't limit you to minimum amount. However, you need to take into consideration the costs. If our minimum brokerage is 98 Rand per trade, okay, if you want to go buy 1,000 Rands worth of shares, your shares have to move up 9.8% to break even on costs. Okay, so the bigger the transaction, the cheaper it becomes. If that makes sense. So, Stephen, if I understand your question, if I buy 50 shares now and on the same day buy another 50 shares, obviously they combine it together and you'll be paying your one brokerage fee on that. But if it's over 2 days, there's two different broking firms, two brokerage costs. So remember 1,000 Rand, minimum cost 9.8%. If you're using 5,000 Rand transaction, your cost, your cost as a percentage drops down to 1.96%. So it might take 1 or 2 days before you break even on those costs. At 8,000 Rand, your cost drops down to 1.23%. Most of the shares can do that in one morning. Remember, with 9,800 Rand per transaction, your cost as a percentage is 1%. So hopefully that answers your question, Stephen, regarding the costs and things like that. Okay, but keep those questions coming through as we're going along. I appreciate it. Thanks a lot. Let's move on to the nitty-gritties, how to choose your first shares. Over the years, I've tried to develop a system where I've tried to simplify the process, and I've learned that basically there's 4 or 5 little steps you want to do, and obviously with each one of those steps, there are some other steps. But step 1 is to narrow down the choice. If you look on the next slide, you'll see that the idea is that if you open the share price page of the newspaper, a lot of us feel overwhelmed and think, where do we start? There's more than 400 shares listed on the JSE. So the idea is to go through what we call a prospecting process. And I use the idea of prospecting. I started from the mining industry. I used to pan for gold. So you have to go through a lot of gravel to find the gold nuggets. So when I say gold nuggets, these are potential winners. The shares are going to grow and they're going to make you money. So I'm going to explain 2 processes just now how to find those shares. But the idea is to make the list a bit smaller, so to create a watch list of the shares that you want to follow. So once I've gone through the process of prospecting for the shares, this is where the website comes in handy now. We have a facility on the website where you can create 3 different watch lists, okay, with 30 shares in each. So the idea is they're going from 400 shares down to about 90 shares now. You don't have to have 90, you can even have less than that. The idea is to make that list more manageable. Once I've got that initial watch list, I want to tweak it a bit further, and this is where step 2 comes in, where I use fundamental analysis and technical analysis to help me scan through the list and get rid of the gravel to focus on the potential gold nuggets, the potential winners. And then I want to build a portfolio of shares, between 8 and 12 different shares, and that's how we get started. Obviously, there'll be times the shares in your portfolio will give you a sell signal, or they become undervalued or overvalued rather, based on fundamentals. So the shares move out of your portfolio back into your watch list. But there'll also be times where the shares on your watch list, nothing's happening there, or you lose interest in the company, and the shares will drop out of the watch list. So the process works like this. If I'm moving shares out of my watch list, I'm looking at replacing it, and so it goes on. So the idea is with time and that, you'll be fine-tuning this whole process and tweaking it. And such time where you have a watch list of potential winners. All the shares in your watch list are potential winners. And you get to know all about those companies in your watch list. The more you know about a certain company or industry, the better your chances are. But anyway, that's the share selection process that I want to discuss now. So how do we narrow down the choice? Those of you just starting out, I suggest that use a simulator. So first of all, to learn how to trade on the market, how to use the platform. But you also see that the simulator, we limited the top 100 companies. This is by market capitalization. So the top 40 companies, and then the next 60 companies, what we call mid-caps. So by using what we call a top-down approach and using financial journalism, you as a complete novice will be able to tweak that list and find potential winners to create those at watch lists, 3 watch lists of 30 shares in each. Okay. So how do we do that? So once you've logged in, or once you've registered a username and password, you log in with your username and password. There's a little button here called Indices. You'll find a little button here called you go to the next page rather. Sorry, there's a little tab here called Futures, and you want to click on the little tab here called Simulator List. What I suggest you guys do is to print this list out. So you need to know the share codes first of all. That's the share. We always trade in share codes, but also you used to understand what is their long name and what sectors they're involved in. So it's one way to orientate yourself into the market. What shares are available? Oh, I've heard of Avenge, the construction company. Oh, I've heard of Adcock Ingram, and so it goes on. So now you start making an initial watch list. But print this list out because you need to know the share codes. One way to start tweaking that list a bit further is what we call the top-down approach. We can call it a funnel approach, or going from the general to the specific. But bottom line is a funnel, a lot of information going in from the top here. You're going to have some filters in place that you filter out a lot of information, and the bottom line, only a little bit of information comes out the bottom. So the process of what I do every day is I look at, especially I use technical analysis, I use my charts to give me a view of what's happening in the markets. I look what's happening on international markets, I look what's happening on the Dow, what's happening on the S&P 500, and going over to Asian markets, what's happening on the Japanese markets, and on the Hang Seng, over to Europe and things like that. So what I'll do at this point in time is establish the trend. What's happening in the market the last 6 months, the last year, 2 years, and things like that. Is the trend up? Is the trend down? Or is the market going sideways? Then I read in the newspaper why. The market moved up yesterday, back in new highs, etc. Why? Okay. Within those different economies, within those different markets, I look at economic indicators, interest rates, and level of inflation. Okay. I use the oil price also. I include the oil price in that. The Brent oil price, we're hovering around about $111. We have come off from 115. It's got a lot to do with the whole Egyptian saga, the story happening in Egypt, but also the Syrian possible war in Syria being averted. So obviously the Suez Canal and all that kind of stuff is still on track. But the idea is that you're reading, keeping up to date with information. Have a view what's happening in exchange rate, what's happening with the dollar relative to the yen, dollar relative to the pound, dollar relative to the euro. Is it getting stronger or weaker? Okay, what's happening with the rand relative to the dollar? We've been hovering around about $10, 10 rand to the dollar. Yesterday we got a bit stronger until the current account came out and it was a bit worse than expected, and then we weakened again. Okay, so have a view what's happening with exchange rates. Have a view what's happening with gold price. Have a view what's happening with the platinum price. Okay, so obviously we're going into strike season. There's a lot of wage negotiations going on. There's a lot of uncertainty. Usually when they have strikes, they're very violent. Obviously the mine shafts are closed. Obviously that does affect the production and things like that. So taking those all into consideration, how does it affect the local market? When I say local market, that's the JSE all share, all the shares in the market. What I suggest you then is break it down by industry. If the rand's getting stronger, what sector should I be looking at? Financial sector, would I benefit from a stronger rand or weaker rand? Okay, so I believe that you should have some rand hedge element in your portfolio. It's companies that either have exposure offshore, be it through exporting, or have operations offshore. So, look at some financial shares, look at some industrial shares, look at some resource stocks. Within those different industries, look at specific sectors now. So when I say financials, obviously we're talking about banks, the insurance, and listed property. When I talk about resources, are we talking about gold and platinum and mining and paper and steel and that kind of things. And industrials, obviously widespread. We talk about telecommunications, we talk about diversified industrials, we talk about pharmaceuticals. Okay, so within those different sectors now, you're chunking down a bit further, and you look at individual shares within those different sectors. Okay, and from there, within the banking sector, I might look at the old ABSA, which is now called Barclays Group Africa. I might look at First Rand, I might look at Nedbank or Standard Bank. In the insurance sector, Sanlam and Old Mutuals, and in the property sector, Growth Point and Redefine. And so it goes on. Bottom line, I want to take those shares now and we're going to compare it to our checklist. And I will discuss our checklist just now. We've got a fundamental checklist and a technical checklist. Just to help us sift through the gravel to find the potential winners. This is the process. So this is one way of prospecting shares for your initial watch list. The other one is obviously tied very closely to that is financial journalism. Reading the newspaper, alternatively is obviously websites, reading the Bloomberg website and Reuters and CNN Money, Business Day's website, Business Report, and so it goes on. If you don't have a time to read on a daily basis, you can subscribe to the weekly publications like Financial Mail or FinWeek or Finances and Technique. Okay. We talk about international websites, you also have the PSL on website, there's a lot of news articles, MoneyWeb, Pin24, and so it goes on. Just be careful of analysis paralysis, where you want to try and read everything, when you subscribe to all these newsletters and tip sheets, and you don't make a decision, you don't make money. Okay, so be very selective in what you're looking at. What I always do, I actually still get the Business Day newspaper every day, the physical newspaper. I scan through the newspaper very quickly, looking at the headlines, but I'm looking for the shares that I might know that's in my watch list or in my portfolio. So then I go back to those articles and I read the articles. One way also to find interesting shares for your watch list is to look for bad news. So there is a lot of bad news at the moment. So you want to find out, is this a recovery situation? If it is, then obviously you want to do further investigation. But those two strategies alone will help you find shares for your watch list. So here's a question coming here from Barry. Barry's asking you what about fundamental analysis and technical analysis. Yes, obviously you can use the website for the fundamentals, scanning it using the value filter, scanning for opportunities. So that's one method I use a lot, is the fundamentals. But also you can use various technical programs. I use the WEN software to scan based on various technical criteria for opportunities too. So yeah, there's 4 different methods, and I like to combine them all together in creating that initial watch list. So how do you create a watch list? When you first go to the website, you'll have a default watch list. So step 1 is to just click on the little button, watch list. Step 2 is create a name. And I suggest give it a descriptive name, be it mining shares or my financial shares or my industrial shares. Okay, you'll have 3 little tabs, you can switch between them. So what's important, obviously, add the share name in, click on the add button, but you need to also then add the share codes. And that's why I say it's important to print that list out. You want to add ABSA to it. Obviously, the ABSA's changed its name now. It's BGA. SASL will be SOL. Anglos will be AGLs, and so it goes on. Okay, so you build up a watch list. The watch list is powerful in the sense that it will show you the movement for the day. You can see most of these shares now, compared to yesterday, it's red, it's gone down. Okay, some of these shares haven't traded as yet. This is a snapshot in time. But it's a big time saver. The reason why I say that is because now it puts you in the starting blocks. Because you can also click on the share code. Once you click on the share code, it takes you through what we call the share info page. And this is where you gather more fundamental information. And that leads me to step 2, gather more information. So yeah, I'm looking at a company called Hold Sport. Through that share info page, you'll find a section there called Company Analysis. It's a analysis written by IFR. They work with us. They're independent. They give you a bit of a spiel, what's the nature of the business, a bit of a write-up on the company, but also give you a recommendation. So this helps you also to fine-tune your decision-making process. I also find the watch list useful in the sense that there's a little button here called View as Investor. You click on that little button now, it changes your watch list now to a value investor. You see, and from there I can click on each individual column, and from there I can see which shares are undervalued in this situation based on PEG ratio. Some of these shares are yellow, based on the legend of what we call fairly valued. Okay, I want to focus on shares that are undervalued, that are profitable, no financial risk. And that leads me to my checklist. So I said 3 criteria I'm always looking for. I'm looking for undervalued shares. Just using that one column, if I go back, this is the P ratio here. Okay, the average of the market right now is about 18. So ideal situation, looking for anything below 18. Okay, very simplified. That are relative to the market would be considered this cheap. I prefer to use things called PEG and price NAV, but we can discuss those in future webinars coming up. Secondly, I'm looking for companies that are profitable, and that's where the return to equity ratio comes in. Okay, anything above 15% is sustainable, but that also helps me eliminate a lot of the companies that are not growing as fast as I want. Risk management, remember I'm going from shares into more riskier asset class called shares. So I don't go into companies that are bankrupt. There's possibility of going bankrupt. So I'm looking at interest cover. My benchmark there is 3 times cover. Okay. My third step is to gather technical information. Basically, 3 criteria I'm looking at here is that the trend must be up. And yeah, use cycle analysis and moving averages and things like that. Remember, this is in the context of share trading, equities. Within that long-term up bullish trend, the market still goes up and down, so we talk about overbought and oversold. Remember, it's cyclical. That's where your oscillators, things like MACD, moving average convergence, divergence, and RSI and stochastic, and all these other technical indicators will help us determine are we at the top of the cycle or at the bottom of the cycle. Remember, technical analysis, we look at 2 criteria, price and volume. So it's also important to look at volume indicators. So we're talking about on-balance volume and volume price trend. And also what I'm looking always for is for shares outperforming the market. Relative to the JSE All Share, I'm looking for outperformance. If it's underperforming, obviously I'm betting on donkey at the end at the back of a horse race. So this is where the relative strength analysis comes in. Just quickly to show you what I'm meaning here. This is Sasol. You can see that the trend is bullish. It's above its moving averages. This high is higher than that one, higher than that one. This low is higher than that one. So this is what we call a bullish trend. Bottom graph here is what we call MACD. It's an oscillator, moves above and below zero line. Anything above the zero line is what we call overbought. Anything below it's oversold. That there would have been an ideal situation to have bought in. Okay, I'm a bit more conservative. When it crosses up through that zero line, that's where you're bought. So you're getting very close to it. So obviously the moving averages, at this point in time, we're trading below that 50-day moving average. Here we've gone above it. So I got confirmation from both my indicators. This is on what they call volume price trend. This should be confirming price action. Remember, it's accumulation of volume. So yes, that point in time also would have been a good time. You can also see the trend here based on relative strength. The trend is up. It means it's outperforming. So Sasol at that point in time was a good time to buy. So now I'm using hindsight, but you can see where this is until about a day or so, about a week or so ago. Fundamentally, the share is still very undervalued. So I still believe there's still more upside. We're very close to its all-time high, very close to that 500 Rand a share. So maybe buy when it dips back. You can see the oscillator at this point in time was showing some weakness, what they call a bit of divergence. This high is lower than that one, whereas the share price is still making higher highs. But we discuss these kind of technical indicators in our webinar at the end of the month. Okay. So the last step is that you're going to start creating a balanced portfolio. And those of you just starting out in the market, I suggest use a simulator. You see in the top left-hand corner, you'll find a thing called a simulator. All of you will have 100 Rand, 100,000 Rand fictitious money. Remember, this is play money, monopoly money. And I always say it's monopoly money because people will phone me and say, sure, I've got 100,000 Rand in my account. How do I withdraw it? I say, it's play money. So please give me your Mickey Mouse bank account and I can transfer it. Okay. I was just joking there, but remember, it's 100,000 Rand, fictitious or virtual money. If you make a mistake, you have a facility where you can reset it. But always try and treat this as real money. If this was a situation, you made a mistake, obviously the opposite would be to sell. And then you'll learn from the experience. But this side would work. You select, obviously after doing all your homework, you select new order. Second step would be to enter the share code and then click on the go button. In this situation, I'm looking at Anglo Vol Food Company. I select buy. How many shares I want to buy? I'm allocating roughly about 10,000 Rand to each share on about 10,000 shares. So 10,000 Rand worth of shares, 10 shares. So there's my price. I click on submit. Going to my order book, like real market, there has to be a willing buyer and a willing seller. So you find your order lying over there. If there's a willing seller at that price, you'll find it pops up in your holdings. So click on portfolio, And well, there's your shares. So obviously you'll have higher costs because that includes brokerage costs. So we try to make it as realistic as possible. We also give you some feedback on your simulation. So regarding risk management, how many shares you've got in your portfolio, the spread, and obviously stop loss and that kind of stuff. So it's a learning tool. Okay. So guys, before we answer some more questions, just quick summary, the 4 steps. Narrow down your choice. Remember, we're going from 100. Alternatively, you get 400 shares. I suggest rather use the fundamental analysis available on the website. But you need to prospect for potential winners. Don't just go buy the share because you think you like them. You're going to find shares that are undervalued, profitable, no financial risk. Okay. Your goal is to create an initial watch list and from there to fine-tune it. So say, remember, my goal is to look for undervalued, profitable, with manageable risk. Those are the kind of shares you want to buy into from a fundamental point of view. Technically, it must be in the bullish trend, ideally at the bottom of the cycle, but still outperforming the market. If you combine those 6 criteria, being the odds in your favor, you're the ideal investment. Okay. So you're building a balanced portfolio. When I say balanced, remember, some financial shares, some industrial shares, and some resources. Okay. The structure of your portfolio, it's spread between large and mid cap stocks. Alternatively, if not on simulator, maybe add some small cap stocks. Anything outside of the 100 becomes considered small caps. Maybe look at the 1 or 2 little shares in Alt X, but spread it between 3 and 5 different sectors and 8 and 12 different shares. You don't have two little shares or your eggs in one basket. Risk, you don't have too many shares. You have to spend time analyzing those companies. And then those of you that are starting out, I suggest use a stop loss facility, especially on the equity side. You have a trading stop loss facility. Use it. It's a tool to minimize your losses as such. Okay. So upcoming webinars, as I mentioned just now, at the end of the month, we have a thing called technical analysis. So those of you that want to learn more about technical analysis, the process I went through just now, those 5 or 6 indicators, I'll be discussing that in the webinar at the end of the 24th of September. So please book. It's filling up fast. Remember, it's limited to the first 100 people. First come, first serve. In October, we start talking about equity derivatives, single stock futures, CFDs, all in trading again. Those of you who want to learn more about fundamental analysis, what I meant by return on equity and PEG ratios, end of October, I'll be discussing that in our webinar. I'm a successful, the most popular webinar this year has been the Japanese candlestick, so this will be the repeat. Those of you guys that missed the beginning of the year, I'm repeating it now. Very popular with the traders, candlesticks. You want to become a successful trader, you need to understand how candlesticks works. So also to tie very closely with fundamental analysis is the strategies. We talk about value investing and growth investing and using dividends. So those of you looking at investors, look at that strategy. When our last webinar for the year will be on the 11th of December, very closely linked to Japanese candlesticks. They've been around for about 4,000 years. About 1,000 years. Point and figure charts. I say it's a lost art of point and figure charts. They've been around for about 400 years. Okay. Our forum meetings next week Tuesday. I'm in Victoria. So those of you guys are based in Victoria, I'm coming through to Centurion Country Club. We'll be discussing the market in general. I do some training there, but the idea is more talking about the market and talking about individual shares and things like that. Those of you based in Durban, I'll be coming down to Durban on 7th of October, and I'm back here in Joburg in November, and our last one for the year will be back in Cape Town again. Okay. So guys, my objective today was to show you how you can maximize your returns. Always do your homework by using fundamentals and technicals. Okay. Remember your goal is capital growth and also income and growth in that income. So we use what we call quality and value, and this is where the website comes in handy. So that's how you would maximize your returns. The other side of the coin is to minimize your risk. So remember, investment-specific risk, you want to diversify your portfolio. You don't want to have all your eggs in one basket. You want to spread it out. Market risk, that's where you use your stop loss and hedging and things like that. So hopefully you guys have got a foundation today and you understand the basic share market concepts, the basic share selection process. This was a very quick overview. Hopefully you guys learned from that. You guys will be getting a survey questions after this presentation. please add anything else you'd like to know more about. If you want to know more about the selection process and more advanced strategies, please let me know. Okay. But as you gain more knowledge regarding fundamentals and technicals, you will add stricter criteria to your selection process. And over time, obviously, you'll hone your capabilities or your abilities, and you'll make better investment decisions. Okay. So guys, from my side, good luck and happy trading. Let me see if there are any more questions. Oops, there's quite a few coming through now. Hey guys, okay, great. That's just answering Jason's questions. Satchik's a good idea. This is from Liz. Liz, nice to see you again. Satchik, yes, is a good idea. Remember, it's also a share in the sense that it's a basket of shares rather. So through one share, you have access to a basket of shares, being Satchik's 40. So you'll have access to the top 40 companies in the market. So that's a great way to have exposure to it through one share to a big basket of shares, look at it that way. So you'll be able to track, there's more than 63 different exchange traded products available on the market. So within the SATX fold alone, you've got the SATX Indeed, the top 25 industrial companies, the SATX Fini, which is the top 15 financial shares, that would be the banks, insurance, and listed property, the top 10 resource stocks, and things like that. So there's various ways of having exposure to the market through an exchange traded fund like SATX. So hopefully that answers your question, Liz. There's a question here from Alistair. Hi, Alistair. Does PSG act as a principal? No, we act as agents. Remember, we're execution only. I'm talking about the online trading platform. So we act as an agent between you and directly with the JSE. So hopefully that is a question there. What about bonds? Now, PSG, we don't trade in bonds itself. When it comes to bond trading, Alistair, it's mainly for the big institutions. If you want to have exposure to the bonds, I suggest rather trade through one of the ETPs, exchange traded products. I think there's one on ETFs rather. That gives you an entry into that. Your minimum exposure of bonds is usually about R1 million. So yeah. How does one find dividend shares? All shares are mainly dividend. So you're looking at when you go into the value investor and that, the last column always would be dividend yield. It's got a dividend yield, it pays dividends. Okay. Yeah, obviously there are various dividend dates available regarding that. But going to my TradeWise report every day, I highlight the last day to trade and when these companies trade, when they go ex-dividend, things like that. I usually try and put out a week ahead. That give you also a good indication. How does WEN get international data? This is another question from Alistair. Unfortunately, the WEN has not got any international data because of the costs involved. So no, WEN doesn't have any international data. I use another program called Metastock, which helps me in that sense there. But obviously, there's additional cost there. How do you determine a stop loss? This is a question from Amit on stop losses. Could you please explain at some time regarding CFDs? Yeah, there's one coming up in October. I'll be discussing CFDs and single stock futures more in detail. Okay. This is a question from Brian. Is there a possibility that from Brian, that the whole market can fall? There's always that potential. Remember, our market, we're trading on 18 PE, which is an all-time high, and we're making new record highs. But that's a lot to do with just positive sentiment regarding the economic recovery. So there's nothing really that we overvalued that's going to have the bubble burst. So there's a very small chance that the market can collapse now. Unless the Third World War breaks out and things like that, and that everybody panics. Yes, that's the only way we're going to see this market crash right now. Okay, I answered your question earlier on about Ayanda, about minimum amount. There's no minimums, but obviously the costs, our minimum cost is 98 Rand per trade, 1,000 Rand, your share has moved 9.8%. I suggest get to about 5,000 Rand minimum per transaction, then makes it worthwhile. Guys, I'm running out of time, so thanks for your questions. If I haven't answered your questions, I'll be tackling it through on the emails. But guys, thanks for your time. I hope you've enjoyed it, and we'll talk again. Bye-bye.